Hi, and welcome to The Full Perspective. I'm Charlie Thomas, the content director for the Insurance Insider, and each week I'm going to be talking to some of the Insider Publishing senior staff to dig into the week's most significant stories. Today I'm joined by Inside P&C's interim news editor, James Thaler. Hi, James.
Hey, Charlie. How's it going?
And Inside P&C's director of research, Gavin Davis. Hi, Gavin.
Hi, Charlie. Thanks for having me back on now that I've had a haircut. I was told until that happened, I was confined to podcasts only.
I'm just jealous you've had a haircut. I'm still waiting for mine. It's coming at the end of the month, so we'll see if it looks better then. So let's get straight into it. One of the biggest stories in the States for the past couple of weeks really has been the success of Lemonade's IPO. So following the stock's listing on the New York Stock Exchange at the beginning of the month for an initial offering price of around $29 a share, the stock soared more than 139% on its debut to $69.41 a share, more than doubling the company's value. And at the time of recording, it was trading even higher, around $74 a share. Now, regular viewers will remember that Gavin joined us a few weeks ago to discuss his unicorn vomiting a rainbow thesis on the InsurTech's S1 filing. So we thought it would be a good idea to invite him back to give us his latest thoughts on the stock and its performance. So over to you, Gavin.
Yeah, thanks, Charlie. The first thing to say is, we talked last time I was on about the business model, and I think if anyone is interested in looking at that, they should go and read the unicorn vomiting a rainbow piece on the website. Today I really want to talk about what's new since the IPO. And the first thing to say is, I think it was a successful IPO. I think that's pretty obvious. And that there are some consequences that we need to take from that and think about how we think about the model, okay? The first is to say that the consequence of their IPO and the extremely high valuation they are now trading at is the story becomes all about growth. It's not a margin story. They can't outperform on margins. This is insurance, and especially in consumer businesses, it's highly regulated. To meet their valuation and to basically deliver a return to shareholders, they have to deliver growth, and it's exponential growth. So the first thing to say is what they have done through this successful IPO is actually increase the probability of success that they will deliver this growth. They have raised money that they will be able to spend on marketing and continue to fuel that pipeline of growth, which they have been pretty successful at. You can argue at the cost of that growth, but they have delivered growth. The second is that there's some speculation that the high valuation means they can use M&A and use that stock currency. I don't really see it. It dilutes the franchise. It's completely contrary to the story they're telling about, no legacy systems, etc. But it is a possible avenue, they have. And they also just have better access to capital markets. And to the extent that they need to raise more capital to grow or more capital to fund the risk that they're assuming, these are avenues that are open. So they've just fundamentally created more paths to success and increase the probability that they will be able to grow and become a successful company. I think we all have to acknowledge that is clear. The second and sort of related point is that I think the valuation also increases risk in lots of ways. It really increases pressure to grow exponentially. There's no way to justify the valuation other than through exponential growth. Part of that risk is that it then creates incentives to grow at any cost. If you want to keep the stock elevated, you've got to hit your growth goals, and therefore you just spend money to grow and you worry about pricing it later. It's a famously cynical model that you grow and get the customers, then you hope you can find a way to make it profitable over time, whether that's through scale or whether that's through raising prices. You just hope you just kind of have a figure it out later mentality. You also end up creating a vicious cycle where you need to raise capital to fuel growth, and you need to raise capital to fund that growth, and therefore you need to hype expectations so you can raise the capital effectively. But every time you go through that cycle, you end up creating more of a problem for yourself. And the final point there is you end up with a model that maybe doesn't scale. And the more you risk trying to grow quickly, there's risk that the model break down. What they have created is this synthetic MGA structure where they are trying to get the value for the distribution, but put all the risk out the back door through reinsurance. That's fine when you're writing $100 million of renters business. Does that scale when you're talking about the $5 trillion of global insurance market they're trying to address, when you're taking on homeowners and cat risk and all of the different types of risk they might address? I think that's harder to say that you've got an obvious arbitrage that scales in reinsurance, and the more you grow and the quicker you grow, the quicker that problem becomes, that latent problem becomes evident. And then the final thing I'll say is, there's also, one of the pushbacks I've heard around the valuation and why it is where it is because there's an imbalance of supply and demand for the shares driven by ESG investors. And what that sort of comes to is the social benefit mission of the company means that they can ignore the demand for growth and they can say, hey, the valuation doesn't matter. We'll take a long-term view. We're a social benefit company, not about providing returns to stockholders, etc. The problem is, one, hey, that might get management out of a hole, but it doesn't do anything for shareholders who are buying at these prices. The other is to say it probably increases scrutiny of the model and the social benefit mission, which to this day, I think is hard to make a compelling case they have done a lot in that regard. Now, it's a young company, they can do more, but they've given less than $1 million in their charitable give back that they make such a big ploy about in their marketing and attempt to win both investors and customers. So to the extent that you end up having a company that's created a lot of wealth for a very small amount of people, that seems to be a risk, a latent risk in a culture of cancel culture and corporate hypocrisy, especially when you are targeting both investors and customers who are attracted to the values for social benefit mission. Eventually they have to either face scrutiny on that or live up to it. So just before I hand it over to James to tell me all the reasons why I'm wrong, I'll say that one of the things I've been trying to avoid saying, but I sort of want to say publicly because no one else seems to be saying, is that I personally think the valuation is beyond speculative excess and maybe beyond a bubble. I think it's insanity. I think it's divorced from reality in any meaningful way. And the only way you can really explain this company is through a mania of people betting on what they think other people will think about it.
That's a very, very strong view to end on that one. Look, James, I think it would be too far to say that you are particularly bullish on Lemonade, but you're certainly less bearish on the company than Gavin is. And, putting aside the issues around the valuation and the 7 times book value and everything else for the moment, why don't you sort of talk us through why you're a fan of their approach and what they're trying to accomplish moreover?
Yeah, I think more than anything, I think right now people are getting caught up in a couple of different elements of the business. I mean, certainly the valuation is attracted a lot of attention. And I think if you ask the management team at Lemonade, they would certainly tell you, we don't care about the valuation. That'll take care of itself. And then I think the other thing, too, is people are looking at the businesses where it is today. And I think people are quibbling with some of the numbers they're seeing, whether it's the expense costs. And I think it's not fully appreciated. This is a company that's a work in progress. There's a process of data accumulation that's going on. There's a process of learning. If you listen to the messaging from the company, they're all about learning. They're all about adaptation. It's the other thing that stands out too about Lemonade is who they're influenced by, who they're modeling themselves after. And I think some people might think it's hyperbolic when you hear Lemonade management comparing themselves to Amazon, but I think the comparison is appropriate. And I think the criticisms leveled at Lemonade are very similar to those at Amazon. If you look at Amazon's S1 filing, they talked about being a bookstore. Then they laid out the risks that the company faced. They talked about Barnes & Noble eating their lunch. So I think right now when you talk about how large carriers in the P&C industry are going to somehow block Lemonade from being successful, I think you may have a similar argument. People saying the same thing about there's no way Amazon is going to be able to keep up with Barnes & Noble. So I think there are all kinds of parallels in history, whether if you want to compare Blockbuster and Netflix, where people have reacted negatively to startups and there's this huge legacy industry.
I suppose the thing I'd like to pick up on that, right? So you're talking about Amazon. I suppose you'd put Uber as a type of disruptor in the same bracket. And they're all about user experience. That's the thing that's separated them, that's allowed them to be massive disruptors. And Lemonade, I think, most people would agree, has had a very positive user experience journey for their users. But what Uber did, what Amazon did, what Apple did, was to take that initial experience and then do a leapfrog that pushes them above the stratosphere and stops them being, those irritating new startup guys and makes them genuine disruptors for their industry. So do we have a sense yet about what that leap looks like for an insurtech like Lemonade, so they stop just being an irritating startup and actually become genuine disruptors?
Yeah, well, I think the best place to look is what are the problems that Lemonade is trying to solve. And I think that's what's different about Lemonade versus a lot of the incumbents, because I don't think traditional P&C insurance companies think of themselves as problem solving. I don't think they say people just care about pricing. They care about sometimes there's shifts in focus on coverage. Right now, people are talking about business interruption and pandemic risk, but there's just not a whole lot of innovation going on in the insurance industry. And so, to answer your question, right now there are big advertising and marketing costs associated with Lemonade's business. That's essentially what's weighing them down. I think if you want to look at the direction that Lemonade has gone so far, it's that they have been able to get the underwriting under control. They've been able to get their loss ratio down, and one can only imagine that it's going to go down further. So I think that one of the problems they have to solve is how do they do it? How do they acquire customers in a more cost-efficient way? And I think I don't think there's an obvious answer there, but I can tell you as a millennial, I'm not particularly responsive to the billions of dollars that companies spend on advertising on TV. That's not really influencing my purchasing decision. So I think there are other ways of marketing products that haven't really been worked out just yet. So, Gavin, did you?
Yeah, I just want to make a couple quick points. One is to say, the problem with the Amazon Uber analogy, in my view, is that we tend to have a sample bias problem where we look at the successful companies and we say, well, they did it, and we don't look at how many similar companies failed, and they tend to be winner takes all markets and have a lot of competitors, and therefore we have to recognize that the probability of success is low, even if you're sometimes successful. Someone can buy a lottery ticket and win. It doesn't make them really smart, right? So just first of all, when we think about the fact that disruption can happen, we also need to recognize that what the probability of that is, and not just look at the weakness of the industry to it. The second thing to say is when it comes to insurance in general and its vulnerability to insurance, the problem is it's not like an iPhone, right? The way this disruption happens quickly is that you have a killer product or a killer app that you say, I just want that. I want to buy it. I don't care. I don't want my Nokia anymore. I want an iPhone. It's better. You don't really have that cycle with insurance where, I don't like, Lemonade's S1 is full of their mission to make insurance delightful. It is not so delightful that someone is going to see an app and be like, I want that Lemonade insurance. It looks so delightful.
You don't think people are gravitating towards Lemonade, like it's because of the buzz? Because at least in my own personal experience, I would think it would be like probably one of the first places I would go at this point, just because everyone's talking about it, because of the convenience, and that doesn't. I think you even said you're a customer as well.
I was a customer when I was a renter. I didn't when I bought a house. So they failed on their graduation, and I gave them a shot. But the point is not it's you don't go out and say, well, I want to buy Lemonade now. You wait until your time you need to buy insurance, and then you say, well, who's the first insurance company that comes to my mind? Is it Lemonade? Fine, then you get a chance. But that just puts a handbrake on the limit of your growth. This is natural churn. Customers come to the market when they have trigger points like buying a home or moving, or their other insurer raises their prices. It's not just so fascinating yet exponential growth because you're like, I need an iPhone. No one is out there saying, I need Lemonade because I just hate my traveler's renters policy. It's not cool enough. And when I go outside, everyone laughs at me for my outdated traveler's insurance policy. It's just not happening. So there's just like the limits on how and when and the pace of growth. You also have to say that then you're competing against, Geico and Progressive and companies like that, and they're doing a lot of disruption. It's just disruption happens slowly in this industry. So, I struggle when people say, if you're against Lemonade, you're anti-disruption, or you think the insurance industry is perfect. No, I think the market is totally ripe for disruption, but it's just how does that happen and at what pace does that happen? And I think those are important questions.
This is true, right? And also, it's not like disruptors haven't looked at our industry before. Amazon have looked at our industry, Google have looked at our industry, and ultimately they've walked away. And I think some of that probably is because it's a complicated industry to get your head around if you're not from the insurance background. But also, you don't get those fast results because, as you say, it's a really slow annual renewal, type industry where you don't have that immediate upgrade necessarily, which is you into it.
Even more than that, it's also because it's a bad business. Insurance is fundamentally a bad business. It has low barrier to entry. It has low returns. You can have a very few good insurance companies that create returns. Progressive is a great example of this, but they're rare. And could Lemonade be that? Totally. Like you said, they've got a UX that's different. They've got a different model. I do think there are challenges when you talked about can the UX change. Having AI pay your renter's claim is one thing. Having it when your roof has fallen down and you've got uncertain costs and you need to send someone out to do adjusting, that becomes a point where UX is very different to what they've been doing in renters. Especially, I don't know, the more assets you have, the more valuable your house is, the more you have things like art or expensive possessions. It's harder. UX becomes about how nice is the guy who turns up or woman who turns up to help you with your claims adjusting, and what is that experience like?
Okay, I'll challenge you on that. Parametrics is making a huge impact about that user experience becoming much more progressive, much more reactive, not having to get people involved, not having to wait for an adjuster to turn up. You're already seeing that across agriculture in particular, but you're seeing it across a load of commercial lines at the moment. Why can't that come in and be part of Lemonade's arsenal when they go into things that get attacked by property cat?
I think the answer is basically basis risk. You can maybe do that if you're a professional risk manager and you're okay taking basis risk. You take out the transaction cost and you have a hedge. And there's risk between them. It doesn't trigger quite the way you want to. If you've got a personal line, you've got your grandma and her house falls down, but her insurance doesn't pay out because the parametric wasn't triggered. That's a very sympathetic audience that regulators are worried about. And I don't think that you would want people buying insurance that way. The point of insurance is meant to be that you are covered and you have indemnity for your losses and you're made whole. Most people don't want to spend time worrying about that. Therefore, the right policy and the right type of product for them is something that makes them whole. So that would be my answer.
Okay, very swift opportunity to rebut there, James.
Yeah, I mean, the thing that stands out to me right now, and this partly comes from Gavin's comments, is talking about the urgency of growth, and maybe that's reflected in the valuation. And as I think I probably said before, I mean, I think if you're running a business, and especially if you're trying to innovate, it's valuation. Caring about valuation, obviously you need to raise capital and you want to maximize how much you can raise, but you do need to set that aside. But if you listen to the way the Lemonade management team speaks, they're thinking about a 10, 15, 20-year interval. And I think it's only this external pressure from outside commentators on how quickly they have to develop their business, how quickly they have to solve their challenges. So I think as far as their financing is concerned, I do think Lemonade is going to run into some of the same challenges that you've seen in similar businesses that have had similar ambitions, where they've basically spent a lot of money on investment and there's been a lot of cash burn, and then it becomes a question of how long will investors put up with that, or when will investors' patience run out? So I think the real question is, all right, well, if they have longer-term ambitions, what kind of progress are they going to show over the next year, next 2 years? What does success look like? I think there's already been success so far on the loss ratio front. And I think one of the beauties of them now being a public company is they're going to hold analyst earning calls. So I'm sure they'll get plenty of questions on how they plan to address customer acquisition going forward, and who knows the extent to which they'll actually tip their hand. But if you want to call it a game of chicken, it's going to be a combination of them trying to run their business and develop their business, and investors want to see returns. But from my point of view, you've seen that play out at other companies. You obviously saw it at Amazon. It's still kind of playing out at Uber right now, and it's how much faith do investors ultimately place in the management team? And look, that's if you look back to Lemonade's founding, that's originally how Lemonade got their money. I mean, how do a group of people who have nothing to do with insurance walk in and suddenly raise money and successfully in a business they have no experience in? And it's just like any successful business. You always hear about it. It's the people, it's the vision that you're backing. It's the skill set of the management team, and I think that's probably the most important thing to watch with Lemonade.
What I was going to say was, we could back and forth about this all day, guys, right? That this is one of those, really super interesting, generates loads of column inches companies, and it's not going away anytime soon. So I reckon we park it here for this week, and we agree that we're going to come back and debate it all over again in a couple of weeks' time once the roller coaster's moved on a couple of turns. So there we are. We really can't leave this week, though, without talking about the Allstate deal. So Allstate finally striking a deal to acquire NatGen in a deal valuing the business at $34.50 a share. This deal obviously brings together the fifth largest P&C company in the US and the number 29 P&C writer, and will likely make Allstate the fourth biggest player here. Gavin, just literally 30 seconds on what we should take away from this.
Look, I think the first thing to say is that, at the start of this year, we put out a piece on personal lines saying that we thought that it would follow the model of broader retail and would move towards an omnivore approach. I think you saw the first, omnivore being that, companies have to stop saying they're independent agency companies or they're direct companies and say, we will allow you to buy our products however you want to. We'll meet you where you want to. In some ways, COVID inspires urgency around that because it challenges some areas. And that's one part of the reason we said this is a long-term trend and we think it would be accelerated by COVID. But we saw signs from Allstate before. They had started to move towards rebranding Esurance into Allstate, trying to take cost out to be more competitive. They have had a long-term problem with Geico and Progressive, and they're finally making steps to address that in the direct channel. This seems to be the other sort of wing to that, which is they have a great captive agency business, but it's challenged on a growth perspective. They've made the step on the direct. In terms of omnivore, it fits in perfectly, which is this is them trying to say, okay, we want an independent agency channel as well for where we can't have a captive product. So as a strategy, I understand the omnivore approach, the omni-channel approach. The part where I think is kind of interesting is NatGen's kind of a quirky, interesting company. It's related to companies like AmTrust and Maiden, which have had a lot of problems. in very similar ownership and management. So let's just say they're interesting companies and might not be the first company I would choose as a high quality agency partner that if I was trying to grow there. The other thing to say that's really interesting is Allstate has this phenomenal brand. It has so much brand equity in the US, and that's grounded in the idea of you're in safe hands. That's their slogan. NatGen has some kind of businesses that are a little out there for Allstate, which is a lot of lender placed business. It's higher risk stuff that is sharper elbowed, and the way you treat your customers is very different from the way you treat your captive agency customers. And I think that does carry some reputation risk and business quality risk that makes the move by Allstate interesting. So I'd like to formulate my views a little more, but I sort of raised an eyebrow when I saw it.
Okay. Well, unfortunately, we're going to have to wrap it up there for this week. So my thanks to Gavin and to James for joining me today. Thanks, guys.
Thank you, Charlie.
Thanks, Charlie.
And thank you at home for watching. Until next time, stay well, keep safe, and we hope you'll join us again for another episode of The Full Perspective.